My name is Jim Lee. I'm the founder of StratFi. We're a boutique investment advisory firm focused on what happens next. And over the next half hour or so, I'd like to talk about why cryptocurrency is such a big deal and where it might be going over the course of the next few years. And to begin at the beginning, my great-grandfather was a banker at Chase Manhattan at the turn of the last century. And at the time, the hot financial technology was the telegram. And what would happen if someone wanted to send you money is a message would be sent from one branch to the next. Then that local branch would send out a 12-year-old boy on a bicycle who would pedal out and, knock on your front door and say, hey, you got some money. Why don't you come to the office and pick it up? And 100 years later, we're still basically doing this. It still takes a day to receive your money, longer if it's sent internationally. It's still not necessarily cheap, and we still call it a bank wire. So this whole infrastructure that we have built over the course of the last 100 years or so is due for an update. And the first killer app, so to speak, for Bitcoin was making international transfers inexpensive, cheap, and anonymous. If you look at where cryptocurrency is now, it looks a lot like the internet in 1998. It's still not too late. It's still actually really kind of early. And the reason why I say this is if you look at the number of people that have cryptocurrency holdings today relative to people that had an email address in 1998, it's about the same portion of the total global population. And in the 1990s, the must-have application was the ability to send messages. And today it's about sending value overseas, internationally, locally, etc. Now, one way of looking at crypto and why it might be worth something is to think of cryptocurrency as a digital store of value. And a lot of people think of Bitcoin as a type of digital gold. It's sort of the gold standard, so to speak, because there's limited supply. Everybody knows what it is. You can still move it around. And it's the standard. Up to this point, it's still over half of the total value of cryptocurrency is in Bitcoin at this point. A lot of room to grow for crypto. As I said, it's still kind of early stage. And if you think of cryptocurrency as a type of digital gold, the total value of gold in circulation is about $11.5 trillion. And the total value of these digital assets is about $2.5 trillion, which means that it could conceivably grow 5x before it had equal footing with gold. Now, another way to look at this is sit back and think, what could be worth more than gold? What's more useful than gold? And I would suggest that it's oil still. And you can do oil, petroleum, you can do all sorts of things with it, from power your car to heat your house, to make plastics, fertilizers, cosmetics. I think maybe even Twinkies have a petroleum base behind them. And it's a tremendously useful thing. So there's a class of cryptocurrencies that are being built right now, which I like to think of as digital oil. And what they do is they fuel some of these online transactions. And every time a transaction happens, sometimes these things are burned and consumed in that process. And you can do all kinds of interesting things, from non-fungible tokens to smart contracts to decentralized finance, and then looking at these distributed autonomous organizations, or DAOS, which do things while having no employees and no owners. They're algorithmically managed organizations. To start with the non-fungible tokens, okay, we have the F word here, which is non-fungible. That means that one thing cannot be like the next thing. Everything is unique. This market really blew up in the last year, got big, kind of frothy, I would think. For the most part, these NFTs have, they kind of remind me of collecting comic books in the 1990s, okay? There was a bubble then as well. And in order to sell what you had, someone needed to want exactly the same series that you had in the exact same issue of that series that you had. And if they didn't want it, then you couldn't sell it. Right now, NFTs and these tokens look like they're mostly used for profile pictures on Twitter, and that's their main use. Tokens like this have sold for a lot of money. But the way that I look at it is that every tool starts out as a toy. And right now, non-fungible tokens are the sandbox, and we're just kind of playing around with them. And there's going to be some tremendously good applications to come out of that technology. We just don't know what they are yet. Another application for cryptocurrency is to power smart contracts. And this is what happens when you do a mashup of legal agreements with money with software code. What happens when money becomes programmable? You can do all sorts of things. So right now, there's a smart contract that enables you to buy flight insurance. And it's on the Ethereum network. And if your flight is running late or delayed, the bots will scan the network. If you buy a policy, your flight's canceled, runs 5 minutes late, you get paid as the policy owner. If the flight arrives on time, they keep your money. And this is a really interesting way of automating insurance based on the Internet of Things, based on publicly known information. You can use smart contracts and you can use blockchain in any number of different ways. One is to store records in a way that's very public, very visible. You can track stock transactions, settle bonds. Those are already being issued on the blockchain. Managing supply chains, where you can track the line of ownership from the producer to the shipper to the final purchaser. You could put real estate and mortgages on the blockchain, even do things like voting. You can put it on the blockchain because you can't tamper, you can't mess with the blockchain. Anything on the blockchain is indelible. So lots of very interesting applications there. Going into what's known as DeFi, or decentralized finance. This is a very specific application for smart contracts. So this is an area that's really exploded over the last 2 or 3 years, and a lot of people are still kind of like wrapping their head around it. It started out with roughly $18 million locked into DeFi contracts 2 or 3 years ago, and now it's over 200 billion, and it's just kind of exploding. And DeFi is the ability to do everything that you're doing using the conventional system on this parallel financial system that's being built on the blockchain. And we have a picture here, just kind of a graphic of all of the different organizations providing different services on DeFi. And you can do anything from making payments, transferring funds, to currency exchange from one crypto to the next, to lending money to other people, to fundraising. It's a lot cheaper and a lot quicker to do an initial coin offering than it is to do an initial public offering registered through the SEC. You can do blockchain-based insurance, run portfolios, do derivatives, futures and options contracts, all in sort of this currently unregulated platform universe. Plus, you can do some things that you can't do in the traditional financial system, including micropayments of less than a penny, predictions markets, in which you're betting on the likelihood of something happen globally over the course of the next day or the next few years. And also, of course, the NFTs. So this is, regulatory perspective. It's still a gray zone. I think from a disruptive perspective, some of these distributed automated organizations, DeFi in specific, could be super disruptive. So last year, the 800-pound gorilla, the largest IPO that was issued was for Coinbase. And Coinbase is just a beast right now. They have more customers on Coinbase than Schwab has customers in the US. And every month they settle about $150 billion worth of trades. They have 1,200 employees, and they charge a commission of about 1% coming and going on every transaction. Now there's an alternative platform called Uniswap, which has no owners. It has no employees. It settles trades for a fraction of the amount of Coinbase, and they handle roughly a third of the transactional value as Coinbase, which is just fascinating. So from a bigger picture perspective, these DAOs have the potential to disrupt the disruptors, to disrupt Silicon Valley as we know it. You can have iTunes without iTunes. You can have Uber without Uber. You can have eBay without eBay. I credit this graphic with my friend Gary Goldman, who really kind of opened me up to this whole idea. From a legal perspective, DAOs are now officially recognized as a type of LLC or limited liability corporation in the state of Wyoming. From a broader perspective, though, still the Wild West. People are just all over the map on this. Japan was the first to completely legalize cryptocurrencies back in 2016. Meanwhile, China all but banned them last summer. And in the US, we're still trying to figure out what it is. Okay, we don't know whether cryptocurrency is a type of stock. We don't know if it's money. We don't know if it's a commodity. We don't know if it's software. So we're really trying to wrap our heads around what it is first before we regulate it. I think once we do get some kind of regulatory framework, people will be more confident in cryptocurrency and will rely on it a little bit more readily. So looking at this as an investor, as a money manager, I think of cryptocurrency as its own asset class, just like real estate, like stocks, like bonds, like anything else. It's kind of its own thing at this point. And there are a lot of different types of cryptos. What they're all trying to do is they're trying to solve this trilemma. One is, how can you be decentralized so that nobody controls it, so that you don't have a single point of failure? How can you make it secure? And how can you make it scalable so it handles a lot of transactions? So right now, Bitcoin is very secure. Nobody's hacked it. It's been around for 10 years. Nobody's ever hacked it. They've hacked the exchanges. They haven't hacked Bitcoin. Ethereum, super decentralized. But Ethereum and Bitcoin are still relatively slow. They can only handle 8 to 16 transactions per second. The Visa network, that runs through credit cards and debit cards can handle 50 to 60,000 transactions per second. So you have some of these upstarts like Cardano and Algorand and Avalanche and Solana that they're pretty quick, but they're not as secure. They're not decentralized. I think you're going to have a few different currencies based upon what's most important to you. Now, Ethereum is going through a major upgrade right now in that they're becoming what's going from proof of work to proof of stake, which will enable them to handle a lot more contracts with a lot more energy efficiency. I kind of liken it to taking a fully loaded flight from New York to Los Angeles. And you're flying over Chicago at this point, and you look out the window and you see some guys out in the wing and they're changing out the engine. And you've heard that a jet plane can fly on just one engine, and you hope they're right. And you hope you get to Los Angeles okay. And that's kind of where Ethereum is at this point. They're going through a major upgrade, which will make for a much better system sometime around June or July of this year. And they're working on it. They're doing a lot of systems tests, but you just kind of hope that it's going to work out. From a risk perspective, cryptocurrency is still through the roof, okay? If you look at the risks and the returns of investing in stocks, you're looking at expected annual returns of maybe 10% per year, plus or minus 10% most of the time. With cryptocurrency and Ethereum, it's just completely off in its own zone altogether. Once you start trading cryptocurrency, two things happen. One is that you don't sleep at night. You wake up a few times. And then the second is you just can't stop talking about it. So I started trading crypto back in 2016, and I'd wake up 2 or 3 times a night. And then one time I woke up and I saw that a South Korean exchange had been hacked. And by the time that I shuffled downstairs into my office to get out of it, I'd lost like $10,000 in like 5 minutes. And that can happen with crypto. The volatility is really just through the roof. And almost every year you sort of have this near-death experience. And we're going through one of those crypto winters right now, where most cryptocurrencies are off 50% or more from their price peaks of last fall. And this seems to happen every year. So it's like, the opportunity of a lifetime happens once every 3 months. If you've missed it once, just wait and maybe it'll dip again and then it will, come back. Right now, from a valuation perspective, if you look at the market value, the total value of what's in circulation relative to the value of the network, most cryptocurrencies are not super expensive, at least the good ones, the top 10. In this case, Ethereum is cheaper to being a bargain than it is to being frothy. So if you have a holding period of a few months or a few years, if they're able to manage this transition, I think you could do quite well with your Ethereum. The key here to managing risk is to keep it manageable. I'm a big fan of making mistakes, but keeping them small and keeping them survivable. And there was some research done by Morningstar earlier last year suggesting that the magic number is about a 3% portfolio allocation in crypto. And in this case, they studied Ethereum and they said, hey, if you have a 3% allocation to Ethereum over the last 5 years, you could have significantly increased your annualized returns without significantly increasing your risk. If you go less than 1%, it doesn't make much of a difference. If you go over 5%, excuse me, it's like the tail wagging the dog. Okay, it's all that you can ever think about. It becomes almost a distraction at that point. So for me, that magic zone is about 3 to 5% portfolio exposure, which I have for most of my clients at this point. From an investment perspective, cryptocurrency is a risk-on asset, meaning that when times are good, when markets are going up, it tends to do really well. When things go down, people tend to sell their cryptocurrency first. It is not, generally speaking, a really good diversifier. It tends to move with stocks. It tends to move with commodities. It tends to move with gold and even bonds. They all move together. But it does look like it's going to be an effective hedge against the US dollar. In other words, if the dollar is climbing in value, cryptocurrency tends to decline and vice versa. Now the killer app for crypto, which I think makes it potentially interesting for retirees, is that you can take this traditionally risk-on asset and tweak it so that it generates income and cash flow for you. And there are a few different ways of doing this. One is by staking and baking, where you keep cryptocurrency on deposit to validate transactions. And for doing this, you get the equivalent of 4 to 6% interest. And it's not necessarily guaranteed, but it's considered to be relatively safe. And again, there's no FDIC insurance on this one, okay? You could lend your money out to other investors, other speculators for the equivalent of about 4 to 6% interest on some of these DeFi platforms like Celsius and BlockFi. Or you could do what's called yield farming. And yield farming is when you serve as a market maker to facilitate transactions for other cryptocurrencies. And on an annualized basis, you can earn anywhere between roughly 5% and 30% per year by trading the bid-ask spread. That is the amount, the difference between what people are willing to pay something for and what they're willing to buy something for. Now you compare this to what you can get in a conventional bank account. In the US, it's about 0.5% interest. 10-year treasury bonds, I think, are about closer to 1.5% or more. But it's really a big step up in terms of what you could be earning on an asset, which I think is going to get some attention over the course of the next few years. Now, stepping back big term in terms of where this is all going, I think that crypto has potential to serve as a hedge against inflation. If you look at the amount of money in circulation in the US, the US money supply has increased from $4 trillion to $6 trillion in the last 2 years. And with the COVID lockdowns, we just turned on the printing presses. We increased the money supply by 50% in 2 years. So we have inflation. We've got to live with it for a little while. We need to really understand what that means. If you look at the supply of Bitcoin going over the course of the next decade or two, the total supply of Bitcoin will probably be capped at about 23 million Bitcoin. And that makes it more of a deflationary currency. It doesn't lose its value over time. It actually gains value over time. And at this point, I'd like to sort of go back to the beginning. And this is the expense ledger for my great-grandfather's family going back to 1913. He was a banker and he kept good records. So he and his family bought a house. I think it was in the Bronx, I'm not sure, for $8,400. Property taxes were just $20 a year. At the time, the home entertainment system of choice was the piano. Everyone would get around and sing songs, on Saturday night. He would drive to work or to the railway station in a Ford Model T. And instead of having servants, they bought a new consumer product called the vacuum cleaner. And the funny thing is that they paid for this in installments. because $59, was a big purchase at the time. So if you fast forward 100 years later, the house is probably worth a few $100,000. Property taxes have gone into the thousands. The piano, the piano we couldn't actually even give away 100 years later. We couldn't find anyone to take it. The car could be worth anywhere between nothing to $100,000 if it's in mint condition. And the vacuum cleaner is still probably worth $30 to $60, as an antique of some sort. But I think this is a really interesting illustration of how inflation works. And really the lesson here is that if you want to maintain purchasing power, if you want to maintain value in your portfolio, you can't hold cash for long periods of time. And in general, the value of the US dollar has declined by about 95% over the course of the last 100 years. So here I'd like to kind of wrap things up with speculations and provocations. And these aren't forecasts, these aren't predictions, they're just interesting things that could happen over the course of the next decade or two. And one scenario is suggesting that maybe Bitcoin's going to go away at some point in the next 5 years. And the reason why I say this could happen is that today, Bitcoin's a monster. It's the 800-pound gorilla. It's a beast. It's also a dinosaur. It's big and it's not evolving. If you look at the amount of energy consumed to maintain the Bitcoin system, Bitcoin uses more energy than the countries of Ireland or Vietnam. And there's a bit of a backlash, a bit of a pushback against Bitcoin because it's not energy efficient. Bitcoin is maintained using an extensive group of miners that run the calculations to balance the books. And if Bitcoin drops below a certain point, it's possible that those miners will not be compensated adequately to maintain the system, so it just stops. Nothing happens. It's dead in its tracks. So I'm not sure if this is going to happen or not, but I'm just kind of putting that out there as a possibility. The second scenario is that by 2030, there could be a digital dollar in the US. And there's already been a big experiment with this in China. Just last summer, did something really super interesting. They ran a lottery, and 20,000 citizens won the equivalent of $30 in digital yuan, which they could spend at coffee shops or whatever. But they did something really interesting with this, and that money, those digital tokens, had an expiration date on it, almost like a coupon, so that if you didn't spend your money within a certain period of time, then it was worthless. And you sort of think about it is that if your money could be worthless in 2 to 3 months, then do you really own it or not? You can also do some really interesting things with government-backed cryptocurrencies, like tracking everyone's transactions. Who bought what from whom for how much? So there's a surveillance aspect there. And then the third thing really deals with taxes. You could program a cryptocurrency such that every time it passes from one wallet to the next, every time that it's used to buy or sell or whatever, you could take a little bit off the top and use that to pay your taxes and revolutionize your tax system. So still super early, but right now, again, crypto is in the sandbox. I think the government just wants to see how it works, to see if this is a type of technology that they would like to use for their own policies. So the third scenario may be the most likely. At least this is what I've heard when I've presented this talk in front of IT professionals and other futurists. And that is by 2035, personal identity may be managed on the blockchain. And to give you an idea of how this could work, think about what happens if you go to a pub or to a bar. They card you, they ask for some ID to see how old you are, to see if you're 18 or 21 or whatever. So you pull out your driver's license. And not only are you giving them your date of birth, but you're also giving them your height, I think your weight, certainly your address and state of residence. But in some ways, you're oversharing. With blockchain management, identity management, you could have all of your records in one place, whether it's school records, whether it's healthcare records, whether it's financial records, travel records, etc., on a blockchain, and you only share which records you want to share. You also have the ability, potentially, to have completely touchless transactions once you combine that with biometric data. So if you combine that with your fingerprint or your voice print or any number or combination of other things, you might not need a wallet anymore. One of the big things that happened with COVID is we started to move rapidly away from using cash money to digital payments using cell phones. And in the short term, you may keep your digital identity on a cell phone. You're going to migrate to that. Over the long term, the cell phone might go away and you maintain your identity by your own fingerprints, by really who you are. So that's going a little further out, but there are a lot of implications here for the metaverse and other things as well. So all just super fascinating stuff. Thank you very much for your time today. Here are some disclosures. Keep my compliance guys happy. If you find this sort of thing interesting, feel free to reach out to me. My email is jlee@stratfi.com. Always happy to chat. Thanks again.